Hi friends, welcome back to EzeeHouse.com YouTube channel. Today we'll be doing our first class on derivatives trading. In India, derivatives trading market is known as F&O. We'll be focusing more on options. Before I start, I'd like to tell you that we've hit 300 subscribers and we are aiming to create a community of 1 lakh subscribers, and one of our lucky subscribers stands a chance to win a Amazon Alexa Eco speaker worth 10,000 rupees. So if you haven't subscribed till now, I'll suggest you hit the subscribe button so you stand a chance to win the speaker. So let's start. First, we'll just cover futures and then move on to options. What is a future? A future is basically a legal contract between a buyer and a seller to buy a particular commodity or asset or a security or equities at a predetermined price at a specified time in the future. So in order to understand futures better, I'll suggest we look at an example. So imagine there's a farmer who grows wheat, and with all his troubles, he's scared at the time of harvest that his harvest will not fetch him a good amount, right? So he's scared that if the production also is very good of wheat in that particular year, because of oversupply, he might not get the price which he wants. So what he would like to do with the buyer is set a price at the time of the harvest that if he produces X quantity of wheat, he'll be selling it at 1,000 rupees to the buyer. So he can protect himself from any downside. So he'll enter into a contract with the buyer so that he can sell his crop at 1,000 bucks. Now the buyer, who probably has a contrarian view to the farmer, or say imagine he's a bread maker who's producing bread or other things which are made of wheat, and his motive is that if he keeps his input costs fixed, he can keep his output price also fixed. So he will also enter into a contract with the farmer at 1,000 rupees, and he doesn't care if the wheat prices actually fall and he buys it at 1,000 bucks, because profits don't get impacted, but he has stability as well in his business. So this is what a futures contract is. Now moving on to an option, let's try and understand options from the same example, but let's cover the definition first. What is an option? An option basically gives you a right but not the obligation to buy a particular commodity or asset or equity at a predetermined price at a specific time in the future. So two kinds of options. One is a call option and one is a put option. A call option gives you the right to buy and a put option gives you a right to sell. In this, when you planning to buy something, we say that you're going long, and when you sell something, we say that you're going short. Now let's go back to the original example and say imagine you're the bread maker and you're looking at buying an option at 1,000 rupees because you want to make sure that at the time of harvest you get 1,000 rupees you can buy the wheat. Now the strike price over here is 1,000 rupees. There'll be a cost attached for you to getting into the contract, and that cost in options cases is called premium. So let's assume that the premium is 50 rupees. So your break even will be your strike price plus the premium which you're paying. So 1,000 plus 50 will become 1,050. Now if the price of the wheat actually goes above 1,050, you will make a profit. So let's take the example that the price goes to 1,200 bucks. Now if it goes to 1,200 bucks, you still have the right that you can buy the wheat at 1,050. So in that case, you make a profit of 150, which is 1,200 minus 1,050, you get 150. Now what happens if the price actually goes down? If the price goes down to 800, you will end up making a loss, which is 1,050 minus 800, and you will have a loss of minus 250. But since you are the buyer of the option and you don't want to take that hit, and since it's an option, you do not exercise this option, because rather than having a 250 rupee loss, you will take a 50 rupee loss. So the maximum loss you can have is 50 because you will not exercise the option and you will take a hit of 50 rupees in this case. Now let's understand this with the help of a diagram, and I'll show you how it works. Now this is the diagram which clearly shows you that his break even is happening at 1050 and his loss is limited to 50 rupees and his profit is unlimited. On the paper, it looks good that the profit is unlimited, but actually within a specific period, and generally stock prices will not go to infinity. So profit on paper does look as if in call options you have unlimited profit, but in reality you don't have that case. Now, what is the other situation for the farmer? Farmer, you have to look at, be the seller of the option, right? So you're a writer. Someone who sells the option is a writer of the option. And in order to get the payout for the option writer, we just need to make a mirror image of this payout diagram on its x-axis. So if you make a mirror image, you will get the payout of the writer. Now let's look at another option, which is the put option, and see the same scenario. In this case, the farmer will actually buy the put option to protect his downside. So he's buying now in the put option, the farmer actually buys the put option to protect his downside. His strike price we're looking at 1000 rupees. The premium we're taking as 50 rupees. So the break even here will be 1000 minus 50, which is 950. Now in this scenario, if the price falls down to 800, you will end up making a profit of 150 rupees, which is 950 minus 850, and you get 150. Here 1000 rupees is his selling price and 800 rupees is his cost, and 50 rupees is the cost which is coming from the premium section. So that's why the profit ends up at 150. Now if the price goes above 1000 rupees, it means that he'll start making losses, and in this case he will not exercise the option, so his loss will be limited to 50 rupees. So this is the benefit of which a farmer has if he looks at options rather than futures, because in futures again he doesn't have the option of actually moving out from the obligation. So on the graphs it looks like this. You can see that the break even is at 950 and the downside is limited to 50 rupees and the strike is 1000 rupees. And in this you can see, so payout for the writer of the option or the seller of the option, you just need to make another mirror image on the x-axis and you will get the payout for the writer as well. Now, since we've looked at these four cases or the four positions, we can see that a long put is basically a bearish position and a long call is a bullish position, and a short put is bullish and a short call is bearish. Now this is basically the two kind of options which are there, which is the put and call. There are different kind of investors, and you have to understand that investing is not the same as trading. Trading, there are different kinds of traders and there are different people who have a different mentality who are investors. So investors generally invest in long term and they should not be impacted by short term movements. But options traders actually has to keep a very close eye on the market, especially a person who's trading on call options, who's probably a buyer of options, because his price gets impacted more by stock prices. People who are positional traders and not intraday traders will actually end up becoming, writers, and mostly big financial institutions where big margins are required for writing options, they'll actually become positional traders rather than doing intraday. But for intraday, generally people look at call options. There is no right or wrong way of trading. It depends on what your mindset is. So some people like, quick trades, and generally if you're buying options, you should not hold your positions for more than 1 or 2 days, because there's an element called time decay. And, we'll look at in the next classes, probably in the next sessions, what the Black-Scholes formula is and how stock price, exercise price, volatility and interest rates and time to expiration actually impact option prices, because these also have an impact in options, and it's better that you understand all these things. And if you're looking at trading in options, I'll suggest you start off with doing paper trading for probably a month or two. Once you feel comfortable by taking positions in options market, only then go ahead and trade. And trading requires a lot of effort. You have to practice it. It's not something which will come in one day. You will probably not even understand quite a lot from these videos. You'll have to see these videos over and over again to get a better understanding what options are and what derivatives are. So in India, you need to understand most of the trading actually happens in the options market. So close to 90% of the trading will happen in the options market, and most of the trading happens either on the Nifty and on the Bank Nifty, because these are the only ones which have enough liquidity in the market. Stocks, if the stocks are in news and there's a heavy activity in these stocks, and only then will you have enough liquidity to actually trade, especially in the options market, for a particular stock. So ideally, most of the traders will be limited to Nifty and Nifty Bank. So, before you start trading, I'll just like to clarify that this is more from educational purposes. And if you go ahead and you trade, I'll suggest that be comfortable with what options are. And once you start doing equities, do futures, and then probably graduate into options. So I'll also, like to hear from you guys that how you like this video. If you find our video, helpful, then we'll probably mention it in the comment section, and we'll look at taking other topics more in detail on how options should be traded, what strategies should be there. Another thing is, do not trade naked options, and especially out of the money options, because most financial institutions and professional players will always hedge their positions. They know what is their profit, what is their loss, what is the maximum loss they can have, and they're pretty well. They do not mostly trade in naked options. They'll always have their downside protected. And a lot of retail traders actually get into options trading, understanding it, and take naked positions. Like if someone is right most of the time, has a strategy where he's right 80% of the time, it only takes one bad move to actually have a big capital loss in these. So I'll suggest, you have a good understanding of what options are before you actually go ahead and start trading. So start with doing paper trading. Once you get your strategy and you understand options, then go ahead, probably dabble with some money which you can afford to lose, and then start trading with a clear strategy. Because the biggest winner in options and general trading is what your temperament is. You should not take impulsive calls. You should not get greedy. These things probably come with practice and depends on what your temperament is as a person. And there is no right way or wrong way, right? Investors in the long run will end up making more money. And if you get a 10 bagger stock or a 20 bagger stock, then you are better off being an investor. But investors have a different mindset and traders have a different mindset. It's like to see their strategies play out in a short period of time. And it is a way of earning money, and it's like a full-time job. So mostly part-time traders and small traders will actually end up losing money. So this is our session, and do let us know how you liked our videos.